Hey everybody, it's Daniel here from Here for Us. Hope you're all doing well. Let's talk about today's market movements. Not much in terms of stocks and equities today. We just saw a couple of bounces up and down, kind of a range kind of trading today in equities. But what was really interesting to see was bonds picked up, especially after the jobless claims numbers that came out today, this morning. We got jobless claim numbers coming higher than expected, around 230,000, basically saying that these jobless claims are being filed more than expected. So when these numbers come in higher, basically suggests that people are looking for, they're basically unemployed and they're looking for some help from the government. Now, on top of that, you have the continuing jobless claims, which is a number to really keep an eye out on because that number came to be at a 2-year high. So this number goes back to when we saw the jobless claim numbers get better from pandemic, right, from 2020. But this number is now picked back to the 2-year high back in December 2021, when numbers they did come off from the highs quite a bit, but still relatively high, right? And this jobless claims number, the continuing jobless claim number, is really important because this is something that you want to continue to track, because if we start to see a trend that's going up higher and higher, that suggests that weakening in the economy is yet to come, which is going to eventually feed into that unemployment rate. Now, the reaction from the bond market was very simple, just a simple buy, and bonds went up because, it's a safe haven asset. Stocks, on the other hand, you did get initially some kind of rally because, again, related to interest rates. It would basically means that the Fed would not continue to hike aggressively, and that's positive for equities. However, it did not last for very long, which was a crucial point, and you got a lot of mixed trading after that data point, and basically suggesting mixed signals, right? Do we take this number as a good number, saying that, hey, bad news is good? Remember, I talked about something like this where I said that bad news, weak data, aka weak CPI, weak jobs numbers suggest that less need for higher rates, which is great news for stocks, right? Except today, initial jobless claims and continuing jobless claims didn't really propel stocks to go higher, even though it's been rallying for the past couple of days, especially on a weaker CPI. Not saying that it can't anymore, but all I'm saying is that it had mixed feelings about this data. Now, it's going to be important to continue to watch this. Like I mentioned before in my previous videos, it's going to be important to see if bad data ends up being bad for equities, right? Because right now, what we've been seeing is bad data is good for stocks, right? Bad data is good. When does bad data starts actually being bad for stocks? And you start to see the decoupling of stocks and bonds, where bonds go up and stocks come down, right? Unless it's a soft landing. And if this is truly a soft landing, in previous examples like 1995, you had stocks and bonds go up. The long end of the bond market did go up 30%. The stock market, especially US tech, also went up close to 40%, right? So if that's not the case and it's not a soft landing, then yes, you could get flight to safety, bonds continue to rally and stocks sell off. But the only question is this a soft landing? And that we will know in the coming months more and more as we see the data progress. But right now, with the weakening in the data, signs showing that demand is slowing down, bonds starting to pick up, which starts to make me think that, is this the bottom in bonds? We've been seeing quite the sell-off in bonds. We heard about a couple of notable traders, hedge fund investors out there who were massively short bonds have now gotten out of that trade and are now thinking about the steepener when it comes to the yield curve, which means that they are somewhat bullish that rates or bond prices are going to go up. Even if they're not bullish on the long end, especially, it should mostly mean that on the short end of the bond curve, we will see some relief in those rates, right? Can you still get a steepener when bond prices are selling off? 100%. All it takes is just the short end not to move and the long end to continue to sell off, right? That could be a possibility. But what you're seeing in the chart right now, bonds are holding up here, and especially the long end. And today, you do see some holding up, and you do see all the bonds on the full curve going up in price. And if it does sell off, like we did see yesterday a bit, especially in the overnight session as well, especially after CPI, right? If it does sell off a bit, you don't see it as aggressive as previously when people were really shorting the heck out of bonds, right? So really, as a whole, when you look at the chart from a bigger scope on the daily or weekly, it's really just in this tight range with a slight bias of prices slowly moving up, right? I think what is it going to take for bonds to really start to move up and for yields to come down? In terms of the stock market, we will see how they take that bond move. But what I think it will take for bonds to move up is signal from Powell, basically. And, the bond market hasn't got that yet. Hasn't got it from the data yet. Data is still not that weak in order to get massive moves in the bond market. But you're seeing some sort of, I don't want to call it a bottom, but some sort of resistance to not go lower or make new lows, I should say, right? Or resistance for the long end yields to continue to make all-time highs again, right? Or not all-time highs, or new highs for the year, right? So, it will all depend, I think, on two things. One, the data. If the data comes really horrendous, then sure, you can get the spike in bond prices. Or two, a signal from Powell. The question is Powell going to give us that signal? And, so far, he's been more of balanced, saying that they can still come in and still hike if needed. You've been hearing that from also other Fed members as well. Although they are in pause mode, but you can get this sideways action in the bond market for some time. And a very good example of this was back in 2006, 2007, and so on, before they started to cut rates. You had the sideways action in the bond market, waiting for confirmation from Powell to start cutting rates or signaling that they're going to cut rates soon. And they're completely done with hiking. And until that confirmation came, that's when you start to get the fuel in the bond prices to move up higher, right? So you could get the same playbook where bonds are trading sideways, and then you get this slight move up higher, and then really fuel pushing the prices higher in bonds and basically causing a massive rally. Because once the Fed starts talking about rate cuts or cutting rates, very unlikely in history that they will cut and then start aggressively hiking all of a sudden, right? Unless, again, like I said, maybe soft landing scenario, right? Possible, could happen, just like 1995. But we will know. We will know until maybe a couple of months, maybe next year, especially when you get a lot of the corporate loans and debt out there that is coming in for refinancing, residential real estate, commercial real estate, you name it. Once that starts to kick in, the refinancing for next year, they're going to be refinancing at a higher rate. That will be very interesting to see, especially with the jobless claims number inching up higher and higher. If you get a massive hit with these corporations coming in saying that they got to refinance at a higher interest rate and rates are still not down, even if rates come from 5 to 4%, it's still relatively high, right? then what could that lead to? Slowdown in demand, layoffs, or I should say first layoffs, followed by more slowing down in demand, leading to weaker guidance, weaker earnings, and so on. And then maybe the stock market will start to see that, hey, actually, bad news is actually bad. Another thing before I end this video is that also oil, very interesting, was selling off quite a bit today. You're seeing quite aggressive selling in oil. And one could argue that, again, this has to do with the demand or this recession, right? If really demand is slowing down and that's what's causing oil to come down, that could be a signal, another cue that, hey, months to come, things may not be looking good, right? Or not, right? It could be completely totally off. Oil has its own brain and its own market, and there's many more other factors that are involved in it. Anyways, let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers, bye.